You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Oil took center stage again this week as investors remained concerned over oil supplies in light of the Libyan violence, tensions in the rest of the Middle East, and a downgrade for Spain's sovereign debt, a widening U.S. trade deficit, a worse-than-expected jobless claims report, and economic worries abroad, not the least of which tied to Japan's earthquake on Friday, all adding to the negatives through the week. Even though Wednesday marked the 2-year anniversary of the bull market, investors did remain in their uncertain mood as the Dow posted broad and steep losses all throughout the week. The other major indexes remained under pressure as well. Well, Kevin Matris, against that backdrop of worry and uncertainty, we haven't had a week like this in a long time.
Right.
But there must be something good out there, and knowing the eternal optimist that you are, you're a good person to turn to for what is positive out there.
Let me look around for something. Let me tell you, I don't think the market, the up move is done by any stretch of the imagination. But it has been a tough week. But I think the main thing that has been spooking the market has been, as everybody knows, the tensions in Libya, the tensions in the Middle East, and the effect it's having on oil and what the ultimate impact is going to be on the U.S. economy. But let me just say, and I've said it before, the unrest in Libya, which really only accounts for about 2% of the world's oil, I don't think that is going to kill off the U.S. economy or the global economy in any way. And as a matter of fact, Saudi Arabia and other major producers, they had even said they were going to step in and make up for any kind of shortfall. Mm-hmm. So the good news, which is what you've asked for.
What I'm looking for.
The good news is that the economy, not only the U.S. economy, but the global economy is strong. And this can be seen in economic report after economic report after economic report. Are we growing at 5%? Like we have seen in other past recoveries? No, we are not. But I really do believe that the more moderate growth path we are on makes for an economy that is more sustainable. And from a longer term perspective, knowing that we are growing at, let's say, a more sustainable path, I believe that this will elongate the boom and bust cycle. Right now, the boom and bust cycle is about 5 to 7 years. I believe the more moderate path we are on will make it more sustainable. We are going to have less excesses built into the economy. When we see the bust, I believe it's going to be much more shallower. So I think there are good times ahead and for a longer period.
All right, quickly, are the bulls running out of steam here?
I don't think so. I think the volatility that we are seeing around Dow 12,000, it is a bit disconcerting. I think investors are unnerved, but I still believe the stock market is the best place to be when you look at all of the other alternatives there. I think savvy investors are looking for areas to get in, not get out of the market. And so, the market has struggled for a while, but if you take a look at just the last couple of weeks, while the market has been down, there are tons of stocks that are up solid double-digit gains over the exact same period. So I do believe that savvy investors are looking at this and they're saying corporate profits are at record highs. They're saying that valuations are still at historically attractive levels. And I really do believe that people are expecting, savvy people, are expecting the market to break out to new highs by the end of the year.
All right, so share some weekend wisdom with us, if you will, on how investors can continue to make money even in this uncertain market.
Right. Well, really, I think the best thing depends on what kind of an investor you are. And what I mean is you need to invest in stocks that are in alignment with who you are as a trader. This is important because if you find yourself getting into stocks that are not in alignment with who you are or the kind of trader you see yourself as being, you're going to abandon that strategy the very moment that strategy hits a rough patch, like this week, for example. Right. You'll be quick to get spooked out of a market, and And then when the market finally does go back up, you'll be wondering what happened. So if you're in a strategy that is in alignment with yourself, you'll have the confidence and the staying power to be able to hold on to the good stocks.
Give me one example of what you just said.
Here's a great example. Take a look at energy, right? Over the last couple of weeks, really over the last several months, energy has been on a tear, and it has been in a classic momentum style price pattern. But a lot of valuation guys who are looking at oil skyrocketing, who ordinarily wouldn't get in, they finally just can't take it, they pile in. So then when we saw the market pull back 2 weeks ago, a lot of outsized losses, oil was no exception. Those value guys who aren't used to a momentum style trade probably got spooked out. Then literally a week later, not only did the market recover, it powered up to new highs. Oil stocks did.
Yeah.
So those guys are wondering, why is the market so unfair? Whereas the momentum guy who knew this going into it is sitting there cashing in, counting all of his gains. So the takeaway is find a style that's right for you. And also too, real quick, the momentum guy would be just as much out of his element in a value style strategy as a value style guy is in a momentum strategy. So identify who you are, stick with that.
Okay, key level on the Dow?
Key level on the Dow,
Quick.
12,000, 12,7, 12,5.
All right, we have more still ahead. Stay with us. Here is your Bull and Bear stock of the week. A heavy equipment manufacturer and a building products company. Those are the Bull and Bear of the week. Rosnian, our research director, here to fill us in on both of these companies. And that heavy equipment manufacturer is Caterpillar, CAT, the ticker symbol. Have you and I talked about this one before?
I don't think so.
Okay. But easy to understand why it's a bull.
That's right. The overall industrial sector here in the U.S. and the demand for construction, for mining equipment globally, particularly in the emerging markets, have been driving players like Caterpillar. And that's primarily the reason why we have them as the bull of the year. Despite some of the minor and, in my view, temporary headwind from the oil price rise, I think the long-term outlook for Caterpillar, particularly outside the U.S., is very, very strong. We saw that in the fourth quarter earnings, again in the monthly sales numbers for January. The company's backlog has reached back the pre-recession peak, and estimates are continually on the rise. About 2/3 is full construction equipment, 1/3 engines. There's momentum on both sides of the business, and my sense is that momentum is not coming down.
Okay. And on the flip side, Universal Forest Products, UFPI, the ticker on the NASDAQ, that building products company that I spoke of a moment ago. So if the building equipment manufacturer does well, why would the building products company not be doing so well?
One word: housing. This is lumber and lumber-related products. 2/3 consumed in the housing market, 1/3 consumed in the industrial markets, and mostly for packaging, for boxes. And in fact, this 1/3 business that gets consumed in the industrial market is the lone shining business for this company. And a lot of us were of the opinion that maybe this one business could carry the business along till the housing market comes back. But that doesn't seem to be the case. The drag from housing seems to be far more stronger than the positive push from the industrial sector, and that's primarily the reason why we have them as the bear of the week. About 45% of revenue comes from this do-it-yourself market that they have, and there is literally no life in that business. They sell that through Lowe's, Home Depot, and other big box retailers, and there's still no life in there. The company has a good balance sheet. Its cash position is not bad. They have exposure to the volatility in lumber prices, but the outlook for lumber prices, wood forest products, is not as bad as it was in 2010, though China remains a variable which could shake up the lumber price outlook going forward. On the whole, the story is primarily centered on the lackluster outlook for the housing market, and that's keeping this company and the stock down.
So they've got a close economic tie there.
That's right. It's primarily a housing-related story.
All right, we are talking stocks again next. And now, Stock Talk, analysis of stocks in the news. Chatter on the street this week that Sprint Nextel is considering buying T-Mobile USA helped to lift shares of all the wireless carriers back on Tuesday. Sprint's own stock, in fact, was reportedly up as much as 7% on that news. Reports from both Bloomberg and the Wall Street Journal say such a deal would combine the operations of the third and fourth largest wireless carriers in the U.S. market. Well, our stock strategists Tracy Reinick and Mike Vodka are here now to take a closer look at Sprint Nextel for us. So there's a lot of varying opinions here on whether this is good, bad, indifferent. There's people in both camps. What do you got on the fundamental side?
Well, Sprint and the Deutsche Telekom, the T-Mobile, neither one has made much money over the last couple of years. It's a very competitive industry, and that's why they're in talks, because there's thought that if they were able to combine into even a bigger network, I think it would cover something like 300 million subscribers, then they could compete against the number one and the number two. Part of the problem is, and why there's a lot of talk about it, is that their networks aren't really compatible. So you would have problems with Sprint having to, do a lot to integrate them, and then what is the benefits of that? So yeah, I mean, they're both kind of weak here, but it would be a merger of weakness, but maybe to get to some strength.
I like the way she put that, a merger of weakness, whatever that may mean to anyone. What's their capitalization, Sprint?
They're about 16 billion or so, and the Deutsche Telekom, the T-Mobile, is bigger. So it would be, and there's talk that they would own about 50% of the combined companies, even in the end. But it would make a considerable size company here, but it has these issues with the two networks not being compatible.
And do we know what the most recent earnings for Sprint Nextel has been?
Well, they lost $1.17 last year. They're supposed to lose about 75 cents this year, and then next year they're projected to lose 54 cents. So as you can see, they're not going to make anything, but the story is getting a little bit better.
Okay, Mike, hit us with the momentum picture here. You're looking back in two different time periods, right?
Yeah, I brought a 1-year chart with me and a 10-year chart, different time frames like you mentioned. And on a shorter term basis, like you mentioned, the market actually liked it. Shares were up 7% on the news. Yeah. And we also saw an interesting development too, is that shares did break a 9-month downtrend. So there is a little bit of short-term momentum on Sprint. But shifting gears into the longer-term picture, taking a look at the 10-year chart, we do see extended weakness here. Their merger that they did with Nextel didn't exactly work out the way they wanted it to, so shares have been under pressure, but they're trying to do something about it right now, so we'll keep our eye on the story and see what happens.
And so maybe because their stock was up 7% right after that, those news stories broke, we can infer from that shareholders are at least hoping for a positive outcome here?
Yeah, I think so, because they know they kind of have to go forward here if they're going to compete. I don't know. It'll be interesting to see kind of what happens. Sprint has a lot of debt right now already. They have about $20 billion in debt, and this would add a substantial, there's estimates that the valuation is anywhere from 15 to 20 billion for T-Mobile. Right. So, I mean, you're going to maybe double your debt load there. That's always kind of a little tricky.
Yeah, I mean, you're talking about, as I said, the third and fourth largest, wireless companies.
Right.
So if they combine, does this just make it like the third largest?
Well, they would be a real competitor for the number one and number two, definitely with that kind of subscriber base and the reach it has internationally. Okay. But the problem is going into the 4G and, combining the networks.
Right. We're going to have a little bit different outlook or different take on Sprint at the roundtable that I'm sure you'll want to stay tuned for, so join us there. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Investor jitters amid continued market uncertainty. That's what we're talking about here at the Roundtable this week with our research director, Shiraz Mian. Market technician Kevin Matris, who you met at the beginning of the program, and Tracy Reinick, our equity strategist, who's been here already, but we invited her back anyway as well. So, Shiraz, let's start with you. We've got a situation here of a backdrop of a lot of worry and uncertainty as far as the market and the economies around the world are concerned. And now we just add in on Friday morning this major earthquake in Japan, which adds to the uncertainty. So let's take it from the global perspective first with you. Does this pose a threat to global economic recovery?
It's a major threat to the overall sentiment and mood. So if we look at from the U.S. market and U.S. economy's perspective, our fundamentals are improving. We have been seeing that consistently over the last 4 to 6 months. It's these events overseas, whether it's the Middle East, whether it's concerns about China's growth, whether it's about the European sovereign debt issue, and now today's tragic events in Japan. All of this is adding to this air of uncertainty and gloom in our market, and that's probably going to weigh on the market till we see definitive events here on the labor market, for example, that the February numbers were not a one-off event, but will continue into the coming months. We need to see the first quarter earnings season that should start later next month. Until that time, we would have this air of uncertainty and tentativeness hanging over the U.S. market.
Okay, Tracy, it is one thing to say it's going to weigh on the market, right? But it's quite another to say that an event like this is really going to add some downward pressure to our stock market. Which do you think it's going to be?
It's a little too early to know. You know, where that quake struck is in an area that's about 8% of Japan's GDP, and the Bank of Japan has already come out and said they're going to do everything they can to, you know, help the economy, get liquidity in there, whatever, but they're already at zero, so I'm not really sure what they're going to do. So, you know, and then you have the oil situation too, which actually might be helped to some extent by what's going on in Japan, strangely enough, because they actually import about 4 million barrels, and right now they're not importing, so supply-demand issues aren't really going to be a concern. But, you know, I don't know. You always have these reactions to these big events, but it's really over the next couple of weeks that you'll really see what it actually is going to do to the global economy.
So there is where, then rather, is when we're going to see whether or not investors' appetites for equities are really dampened or not.
Right.
If I can briefly add.
No, you can't. Yes, go ahead.
It comes at a very bad time for Japan. They have been fighting these deflationary pressures. Their financial picture is way bad than it has been for us in the U.S. And the government has been kind of shaky and doesn't have the level of credibility that it needs to really help the economy. But longer term, an event like this produces the need for reconstruction and rebuilding, and which is always good for growth.
All right, Tracy mentioned oil. I want to bring Kevin in here because you've got some interesting points to make on oil. We've seen oil prices drop a little bit in this past week, but yet that didn't do anything to support stocks. How come?
First off, I think the drop in oil, which has been welcomed, the reason why I don't think it had some huge impact on stocks is because I don't think people believe that any kind of pullback in oil is going to be long-lived. I believe it's very short-lived. Even prior to the Egypt thing, the Libya crisis, and all of the stuff that's happening in the Middle East, the reason why oil was getting to $80 and $90 and higher is because the supply-demand situation. There is a growing demand for oil, and that is why it is moving higher. It is true that the spike that we had seen was caused by all of the unrest. But even if you pull back down, I think that you just come down to a trend line and then it starts trending higher again. So I don't think you're going to see any kind of long relief. But the last thing I do want to say is the idea that higher oil prices is somehow going to be an economic killer is not necessarily true. Look at all the companies in the S&P and the stock market that are in oil, or all of the periphery companies that deal with oil. That means more jobs. Those people who are employed get more money. They dump it into the economy. So I don't believe that crazy high oil is going to be very difficult. But if we see 110, 120, I still don't think that's going to kill the economy. I think it's going to actually help it.
Okay, Tracy, we still have one thing hanging out there that could be a big potential positive. Earnings season coming up, corporate profits at record highs. If those trends continue, that could bring investor sentiment back here.
Oh yeah, definitely. And we are seeing some interesting data from the consumer side. Today we got some good numbers on the retail side again for February, and consumers were out there buying, items you wouldn't normally think they would continue to buy past the holiday season, like clothing and things like that.
Right.
So, some of this is so far not being dampened by the oil and the price of gasoline.
So we can't discount the consumer just yet.
No.
either. All right, Shiraz, your top stock pick of the week.
It's related to oil. Surprise, surprise. It's more of a long-term play. It's a play on the deep water drilling market in the Gulf of Mexico. That market went into a freeze after the BP disaster, but the pieces that need to fall in place for that market to come back are slowly coming into the picture. Diamond Offshore, DO, is my pick on that market. My forecast is that in the second half of this year and then into 2012, we will have a full recovery in deep water drilling. Diamond Offshore is my play on that outlook.
Okay, Kevin?
Sprint, ticker S.
We talked about that earlier in the show.
Right. So I know at the top everybody was talking about all the reasons why it's not such a great company, but I look at this as a turnaround story, right? The reason why I like them is A, they are the third largest carrier in the U.S. They're a leader in mobile data services. They have one of the best 4G networks out there, which is one of the reasons why so many people want to partner with them. They have the highest per customer margins of anybody else out there, and they have some fantastic new products and services. They've got some interesting growth rates. Subscriber growth is expected to continue. Valuations are fantastic. They just broke out of a medium-term downtrend. They broke out in spectacular fashion. I think in the near term we could hit $6 and $8. That's a 63% rise.
All right, you think it's a turnaround candidate?
Yes, turnaround.
We'll keep an eye on it. Tracy?
My company is Deckers, which you might not recognize the name, but you know the product. They make the UGG boots and UGG shoes and all the UGG products. And a couple years ago, those were kind of the trendy, celebrity boots, and everyone thought, oh, that's going to go away, but it hasn't. And they're trading at 18 times, and things look good for them.
All right, well, that's all we have time for. If Kevin seemed a little over the top to you this week, he did to us as well, so don't worry about it. Thanks for joining us. We'll see you next time.